Good evening. Please come to next part of this wonderful chapter, that is trainer ratio. Trainer ratio was given by one person called Jack Trainer. What is the name? Jack Trainer. And this person Jack Trainer says that instead of using standard deviation, use beta. Instead of using standard deviation, use beta. Remaining discussion is the same. If you look at the formula, trainer ratio represented by the letter T is return of the portfolio, or in case of mutual fund, return of the mutual fund minus risk-free return upon beta. So R minus RF upon beta. And what is Sharpe ratio? R minus RF upon standard deviation. So where is the difference? Standard deviation is used as a measure of risk in case of Sharpe ratio. Beta is used as a measure of risk in case of trainer ratio. Is it right? Now here also the formula will tell you how much is the excess return over and above risk-free return. How much is the excess return over and above risk-free return per unit of beta? So how do you interpret this formula? Excess return over and above risk-free return per unit of beta. Is it right? So which mutual fund has performed better? The one whose trainer ratio is higher. Okay. Now underline, it is also called reward to volatility ratio. Sharpe ratio is called reward to variability ratio. Sharpe ratio is called reward to variability ratio. And this is called reward to volatility ratio. Trainer ratio is based on the premise that unsystematic risk is of two types, systematic and unsystematic. Unsystematic risk is called firm specific risk. Diversifiable risk can be diversified and hence only incorporate the systematic risk, that is called non-diversifiable risk, to gauge the portfolio's performance. So in trainer ratio, if you want to compare two mutual fund, don't compare on the basis of their return. Compare return in excess of risk-free return per unit of beta. That they call absolute risk-adjusted return is the trainer plus the risk-free rate. In the illustration discussed earlier, go to Sharpe ratio earlier. There are two funds in Sharpe ratio. Fund A, Fund B. Other details are same. Their betas are 1.5 and 1.1. So calculate the trainer ratio for Fund A. In Sharpe ratio we have given return is 30%, risk-free return is 8%, and trainer ratio says beta is 1.5. Calculate. Is it 14.67% for Fund A? Say yes. B, 25 minus 8 divided by 1.1, 15.45. So who has performed better as per Sharpe measure of performance, as per trainer measure of performance? Fund B. In yesterday's problem it was Sharpe ratio for B which was higher. In today's problem it is trainer ratio of Fund B which is higher. For this particular example, there is a consistent answer. What is the meaning of consistent answer? Fund B shows better performance under both the measures of performance. But is it necessary that the Sharpe and the trainer ratio will always give you the same result? Is it necessary? No, because the denominators are different. So there can be situation where under Sharpe ratio one mutual fund has performed better, and under Trainer ratio the other mutual fund has performed better. Normally they will give you similar result, but they may give you different result also. Both Sharpe and Trainer ratio measures risk adjusted return. The difference lies in how the risk is defined in either case. Sharpe uses standard deviation, Trainer uses beta. So in Sharpe ratio, risk is determined as the degree of volatility in returns. That is a variability in month on month or period on period returns, which is expressed through the standard deviation of the stream of return numbers. So here they are using standard deviation of the return, whereas in Trainer ratio, you look at the beta of the portfolio. That is the degree of momentum that has been built into the portfolio by the fund manager in order to derive his excess return. How the stock moves in relation to market, or how the portfolio moves in relation to market, that is measured by beta. So as a result of the two, the answers can be different. Okay. While Sharpe ratio measures total risk, degree of volatility in return captures all elements of risk. Total risk includes systematic and unsystematic. Trainer ratio captures only systematic risk. When would Sharpe ratio be more meaningful? When would Sharpe ratio be more meaningful? For a diversified fund or for a sector based fund? When will Sharpe ratio be more useful? Sector based fund, because then we are concentrating only on one type of risk. But if you are looking at diversified funds, which ratio will be better? Trainer ratio. So that is also one question that you may get when one has to evaluate the funds which are sector specific, because here there is a concentration only on one sector, like banking sector fund, pharma fund. Sharpe ratio would be more meaningful. This is due to the fact that unsystematic risk would be present in sector specific fund. Hence, a truer measure of evaluation would be to judge the return based on the total risk. The logic is that there would be both risk in a sector fund, systematic and unsystematic, because you can't eliminate the unsystematic risk if you invest only in one particular type of shares. But if you diversify in different types of stock, which risk get eliminated? The unsystematic risk get eliminated, and therefore Trainer ratio would be more useful for diversified equity fund. The reason, if you have diversified, then your unsystematic risk is zero, as these funds are expected to be well diversified by virtue of their nature. Hence, Trainer ratio would be more appropriate here. Suppose they ask this question, for diversified fund, which ratio is more important? Trainer. For sector specific, or where there is unsystematic risk is present, which is more important? Sharpe ratio. Normally they will give you similar ranking, because normally mutual funds are diversified. Normally they will give you similar ranking because most of the mutual funds are diversified. They do not invest only in one or two or few stocks. Many mutual funds invest in hundreds of stocks, 25, 30, 50 stocks. So therefore, most of the mutual funds, they diversify. To summarize, we can say that when the fund is not fully diversified, Sharpe ratio would be a better measure of performance, and when the portfolio is fully diversified, underline, Trainer would be better measure of performance. So these are the questions, they will test your intelligence. One example is printed here, why we should not compare only the returns. This example tells you why we should not compare only the returns to evaluate the performance. We should also take into consideration the risk involved. So in 2005-6, where Fidelity Magellan had earned about 18%, many bonds funds had earned 13%. So can we conclude that Fidelity Magellan is a better performer? The answer is no. If you only look at absolute numbers, it seems that the answer is yes, Fidelity has performed better. 18 is more than 13. But if we then state that the bond fund had about half the market risk, the bond fund had about half the market risk. The risk that you have taken in bond fund is half of what you have taken in that Fidelity Magellan fund. Which is better? Without calculation also you can say. At half of this risk we are getting 13%, which is much more than half of 18%. So if I also take into account the risk involved, then we'll say bond fund has performed better. We don't even need to do the formula for that analysis. But that is missing in almost all reviews by all the brokers. Right? Even this mutual fund advisors who come do the hard selling, they only talk about the return. They don't give you proper advice on the risk that is taken. So now you can tell them, please show me what is the trainer ratio of this fund, Sharpe ratio of this fund, and then we will discuss which is better. The third is Jensen's alpha. We have learnt in portfolio management chapter also. Okay. So Jensen's alpha will basically compare the return that is generated by the fund and what it should have generated based on its type of risk. Based on its type of risk. Every fund has a beta. So you are taking a certain amount of risk. Based on that much risk, this is what is the return that should be generated. This is what they have actually generated. Actual versus desired. This desired. Take the difference. Okay. The difference is called alpha. If alpha is positive, fund has outperformed. Fund has outperformed. It is better. But if alpha is negative, fund has underperformed. Positive alpha in portfolio chapter also means undervalued stock. Now we remember. And negative alpha means overvalued stock. Zero alpha means correctly valued stock. But in this chapter, if we are asked to compare two mutual fund, the one which has higher alpha is better. Okay. So that is producing more return than what is the desired return. So what is the formula? The formula is simple. What is the average or actual return of the portfolio or the fund? What should have been the return as per the CAPM based on the kind of risk that you have taken? If you generate more than that, you have performed better. So this is the difference between the fund's actual return, and those that could have been made on a benchmark portfolio with a similar risk, that is beta. It measures the ability of the active management to increase return above that are purely a reward for bearing the market risk. So if the fund manager is skillful, he will generate positive alpha. Okay. It will produce meaningful result if it is used to compare two portfolios which have similar betas. Like this example, assume two portfolios. Return is given, beta is given, market return is given, risk-free rate is given. Can you find out the Jensen's alpha of portfolio A? Actual return is 12. CAPM return formula, do you remember CAPM formula? RF plus beta into RM minus RF. After many days you must have used that formula. RF plus beta into RM minus RF. So for portfolio A, the CAPM return comes to 11.1%. So therefore alpha will be 0.9% or something. How much? 0.9%. That is alpha for portfolio A. And let us say beta B. Have you compared B also? Or they have not given B? You can just calculate and write there. In the study material, they have not calculated for B. You calculate. What is alpha for B? CAPM is how much? 15. So alpha will be minus 1. Alpha will be minus 1. For portfolio B, alpha will be 14 minus 15 minus 1. But they have written a note, as long as apples are compared to apples, it will give you a meaningful result. In other words, a computer sector fund A should be compared with computer fund B. It is a viable number. But if it is taken out of context, it loses the meaning. Alphas are found in many rating services. So many rating services give you alpha. They don't give you sharp and trainer. But sometimes they say this fund has this much alpha, but are not always developed in the same way. So you can't compare an alpha from one service to other. You can't compare alpha of two sectors, two funds which are different. Short-term alphas are also not valid. Minimum time frames should be 1 year to 3 years is preferable. Okay. Now I have added 3 questions from my side also. Start. Question number 11. In the book only. Consider the following data for a particular period. Portfolio P, market M, average return, beta, standard deviation. Calculate the following measures for portfolio P and the market. So calculate Sharpe, Trainer, Jensen's alpha. Given that treasury bill rate during this period was 6%. So RF is 6%. Where will you require that RF? In all 3. By which of the 2 relative measures portfolio P outperforms the market? So in which case portfolio P has performed better than the market? In Sharpe or in Trainer? The portfolio has outperformed the market. So first you draw this table. Calculation of Sharpe ratio, Trainer ratio and Jensen's alpha for each fund. Calculation of Sharpe ratio, Trainer ratio and Jensen's alpha for each fund. Right hand side 2 big columns, portfolio P, portfolio M or market M. Write here the formula for Sharpe ratio. R minus RF upon standard deviation. Okay, upon SD, standard deviation. What is return of portfolio P? 35 minus risk-free return 6 divided by standard deviation 42. You may or may not multiply by 100. So what is the answer? 0.69. Only 0.69. Okay. 28 minus 6 divided by standard deviation 30 equal to 0.73. Trainer ratio, right formula, R minus RF upon beta. 35 minus 6 upon 1.2. 24.16. 28 minus 6 upon 1. 22%. Okay, is it right? 22. Jensen's alpha, right formula, actual return minus CAPM return. What is the actual return of portfolio? 35 minus CAPM return is RF plus beta into RM minus RF. This is the CAPM return. What is the RF here? 6. What is beta? What is RM? Return of market 28 given na on the second column first line. Average return market time is 28. Can you see? Hello? This is 28. I'll show you. This is the return of market. So this you will take in this answer. 28 minus RF 6. Complete the answer. Final answer. What is your CAPM return you are getting? 32.4. Is it right? So are you getting 2.6%? Sure. What about this? It should be 0 without solving. You are comparing market with market. Anyway, still we'll write 28 minus 6 plus 1 into 28 minus 6. So 28 minus 28. Market with market. Answer is not over. You have to write one note here. Question says, by which of the two relative measures portfolio P outperforms the market? But then one student has asked this question. There are 3 measures. Why in the question they have written by which of the two relative measures? That means do not answer on the basis of Jensen's alpha. Jensen's alpha for market will always be 0. So keep this out. So under Sharp or under Trainer, portfolio P has performed better than market. Check. Under Sharp it is underperforming. But under Trainer on the screen, the Trainer ratio of portfolio is higher than the market. So note will be under Trainer measure of performance. Under Trainer measure of performance, portfolio P has outperformed the market. Portfolio P has outperformed the market. Portfolio P has outperformed the market. Is it right? Now there is a note on expense ratio. Already discussed. Do you remember? While calculating the performance, expense ratio means the percentage of assets that were spent to run a mutual fund. It includes things like management and advisory fees, traveling cost and consultancy fees. But the expense ratio does not include brokerage cost for trading the portfolio. Brokerage is a part of the cost of investment only. It is also known as MER, management expense ratio. Pay close attention to the expense ratio. It can sometimes be as high as 2 to 3%, which can seriously undermine the performance of your mutual fund. Formula for expense ratio. Yes, come on. Formula for expense ratio. Expense per unit upon average NAV. Expense per unit upon average NAV. Higher ratio is not good here. Here we should look for those mutual funds where expense ratio is lower. Lower the expense ratio, higher will be the return to the investors. Okay. Now we will solve question number 12. Following information is available regarding 4 mutual funds. Mutual fund PQRS, return risk beta, risk free return. Is it right? And evaluate the performance of these mutual funds using Sharpe ratio, that is reward to variability ratio, trainer ratio, that is reward to volatility ratio, and comment on the evaluation. Comment on the evaluation after ranking the funds. So they can also ask you to comment on the evaluation after ranking the funds. So only after first you complete the ranking part, you will be able to answer the second part. Okay, on the screen, write down calculation of Sharpe ratio and trainer ratio for each fund. Calculation of Sharpe ratio and trainer ratio for each fund. After that, you draw this table. First column write fund, second Sharpe ratio, trainer ratio, ranking under Sharpe ratio, ranking under trainer. Then write P, Q, R, S. Sharpe ratio, take on your calculator 13 minus 9 divide by 16. Anybody? 13 minus 9 divided by 16. 0.25. Try 17 minus 9 divided by 23. Try again. 17 minus 9 upon 23. 3, 4, 7. Okay. Only 2, 3 digits are enough. 0.35, 9. 0.24. Next. R minus RF upon beta. 13 minus 9 upon 0.90. 4.44. Next. 9.30. Very good. 11.67. Then 4.35. Okay. Now rank. Higher number first rank. So under Sharpe ratio, which mutual fund is ranked first? Is it R? First rank goes to R. Second rank Q. Third P. Sorry, this is third. This is fourth. Now try this one. First, second, third, fourth. Comment on the evaluation after ranking the funds. So write below comment. What is the comment you will offer? The ranking under both the measures of performance. Comment the ranking under both the measures of performance is same. the ranking under both the measures of performance is same. This is possibly because all mutual funds are well diversified. This is possibly because all mutual funds are well diversified. Portfolio R or mutual fund R is the best performer, and mutual fund S is relatively worst performer, Is it right? This is enough? Or you want to comment on second and third rank also? No? Understandable. Try one question yourself. 6 mutual fund experience the following results during a 7-year period. Mutual fund average return, standard deviation, correlation with the market. Oh, so now they have given you correlation. Rank these mutual funds using Sharp and Trainer. Then compare the ranking in part A. So first step will be same. And second is explain the reasons behind the differences. It means this time all mutual funds will not get the same ranking. There can be conflict between Sharp and Trainer. So then you have to explain what can be the reasons for the differences. What is the difference between this and the previous problem? Beta is not given. Correlation with market is given. And in the problem, you are given the market return, market standard deviation, and the mutual fund standard deviation. So you have to apply the formula of beta when correlation is given. Standard deviation of the portfolio and standard deviation of market is given. Yes, formula for beta when correlation, standard deviation of portfolio, standard deviation of market is given. Beta equal to R into standard deviation of the stock upon standard deviation of the market. Stock can be replaced by portfolio or mutual fund. Okay. So here sigma S means standard deviation of mutual fund. Sigma M means standard deviation of market. Sharp ratio formula you know. R minus RF upon sigma. T equal to R minus RF upon beta. Is it right? Now you will complete the table and then we will further discuss. Only up to F you have to calculate. Only for the mutual funds you have to calculate. Do not calculate for market. Keep some space for writing comment also. Be conservative in using the space. Dear students, have you completed? No. Then what you are doing? Solving. Okay. Done. How many of you are still in the work in progress mode? Okay, last. One more chance we'll give it to this lady. Okay, now please answer. Beta of A. Okay, you one person only. Point. 1.8225. Is it right? Next. 2 zeros. 0.975. Then Next, where it has gone? 1975. Okay, C below 6533. Then 1 point. Okay, next. Okay, next. 01. Is it right? Is 0.15. Remaining are right? Okay. So this is a test of your patience. Okay. Now next is Sharp ratio A. 1%. 0.35. Continue. 322. 7625. 6132. 4.5 negative. 0.906 is right. Okay, now you trainer ratio 5.267. 5.94. Okay, 9.3372. 8113. Then 120 negative. No problem. 120 negative. 17.275. Okay, enough. So now tell me ranking under Sharp. Start from A, go up to F. Come on. 4, 5, 2, 3. Okay. Trainer. 5, 4, 3, 2, 6, 1. So you have partially answered this question. Rank this mutual fund using Sharp and trainer method that we have done. Compare the ranking in part A and explain the reasons behind the differences. So write a note. Sharp ratio uses standard deviation. Sharp ratio uses standard deviation, whereas trainer ratio uses beta as a measure of risk. Beta as a measure of risk. Beta is dependent on correlation of the fund with the market portfolio. Beta is dependent on correlation of the fund with the market portfolio. Higher the correlation, higher will be beta. Yes or no? Higher the correlation, higher the beta, because R is written in the numerator. R into sigma s upon sigma m. So if R is high, your beta will be high. And beta is written in the denominator now. Wait. Higher the beta, lower the trainer ratio. Higher the beta, lower the trainer ratio. Why? On the screen for those who want to know. Because you see, trainer ratio uses beta in the denominator. If correlation is high, beta is high. But if beta is high, trainer ratio is low. If beta is high, trainer ratio would normally be low. Then write one more line. In case of mutual fund C, comma, which has a high correlation, comma, it is ranked third in trainer ratio. But ranked second in Sharp ratio. But ranked second in Sharpe ratio, but ranked second in Sharpe ratio. Is it right? One more line, right? Another possible reason could be these mutual funds are not well diversified. Another possible reason could be these mutual funds are not well diversified. Another possible reason could be these mutual funds are not well diversified. This much is enough. So this was about Sharpe ratio, Tanner ratio, Jensen's alpha. In one of the model test papers, there is a question on this Sharpe, Tanner and Jensen's alpha. Okay. Now we'll come to factor influencing the selection of mutual fund. Topic is lengthy because they have gone into all aspects of mutual funds. So what are the factors you should look into? You have a lot of money and you want to invest in mutual fund. So quickly, first is past performance. So net asset value you can compare over a period of time. And if the net asset value has been growing, you can get an idea that this mutual fund has been generating returns. Higher the NAV, the better. Performance is based on the growth of NAV during the referral period and taking into consideration the dividend paid. That is what we have learned. Holding period return we will calculate over a period of time. So we will calculate D1 plus NAV1 minus NAV0 upon NAV0 over the last few years, 5 to 10 years since its inception. And if you find that these returns have been growing or consistent, this is a good mutual fund worth investing. Okay, the formula they have written. Then timing. The timing when the mutual fund is raising money from the market is also vital. So in a bullish market, investment in mutual fund falls significantly in value because the market is already at its peak. When the market has already reached the peak, and that time if you buy, you might lose money because the value can fall now henceforth. Whereas if the market is bearish means very low, buy, because now the value of your mutual fund may grow. But again, what is the peak and what is the trough requires judgment. Okay. So in a bearish market, when the NAV is available at a lower rate, it is the time to buy. The turns in the market needs to be observed. When the market changes from a rising trend to a falling trend and from a falling trend to a rising trend is called turn. So the market is changing from rising to falling means now sell, and is turning from falling to rising. It is a time to buy. Okay, for example, now don't write. If this is the graph, this is where you should buy and this is somewhere where you should sell, because now the future is it will fall. But when will this turn come? That requires lot of years of expertise, experience, okay, judgment. Then size of the fund. Managing a small size fund and managing a large size fund is not the same, as it is not dependent on the product of numbers. Purchase through large size fund may be itself push prices up, while sale may push prices down, as large funds get squeezed both ways. Large fund has an advantage also. What is that? Large means the asset under management is very, very high. Okay. That means they are managing funds of 1 lakh crore rupees. Another mutual fund is managing funds of 100 crore rupees. So this one which is managing 1 lakh crore fund, they will buy also in big number. Their one purchase may be of say 50 crore, 100 crore, 200 crore. So when they buy, prices go up, NAV goes up. And when they sell, the prices also fall. So then you have to accordingly think that if I invest in a fund which has a large asset under management, then in case if they sell, the NAV can fall drastically. Small funds will not make much difference. Like you are a small player in the market, you purchase or sell any number, BSE Sensex is not going to get affected. But a mutual fund which buys thousands of crores of rupees can make an impact in the market. So what is the suggestion? Remain with the median sized funds. So that is one more factor. Age of the fund. So that is again important for how many years this fund is into business. Longevity of the fund in business needs to be determined. And its performance in rising, falling and steady markets have to be checked. So it's like experience. You go to an experienced doctor, yes or no? Or a person who has just passed MBBS and he says, yes, I will do your surgery. 30-year experience, person says, I will do your surgery. Where would you prefer? Somewhere between the two. Yes, 30 years may forget the seizures inside your body itself. Okay. You 30, no chance. You will take both of them. Oh, you have so much money. But that you have to pay fees 2 times. Surgery fees is very high. Anyway, largest holding. It is point number 5. It is important to note where the largest holding in mutual funds have been invested. Check where they are investing. Now you can check their portfolios. And accordingly you take the decision to invest or not. If you think they have invested majority of the fund in some shares which you think are risky or not according to your appetite, then you may not invest. One more factors influencing the decision is the fund manager. That is the one who is going to handle your funds. So as I said in one previous lecture, fund managers have an important role. Many investors look at the fund manager of the scheme, and if they know that this is a good fund manager, he has generated a lot of returns in the past, they simply move to that fund. And if that fund manager leaves, they also leave. Next thing to check is expense ratio. Higher the expense ratio, lower will be the performance, because ultimately it is the investor who will have to bear the bill of those expenses. SEBI has laid down an upper ceiling for expense ratio. So it is like 2.5% for equity fund and something like 2.25% for debt funds, on which there was a question in the exam also on this paragraph. So that limit you have to know. Lower expense ratio will give a higher return, which is better for the investor. Then P ratio. What is P ratio? Do you remember the formula? Profit earning ratio, MPS upon EPS. P ratio, if it is very high, it means overvalued. If P ratio is very low, it means undervalued. It means undervalued. So you have to find out mutual funds with lower P ratio, not with a higher P ratio. The higher P ratio means already overvalued. The ratio indicates the weighted average P ratio of the stock that constitute the fund portfolio, with the weights being given to market value of holding. It helps to identify the risk level in which mutual fund operates. Okay. So in your notes you can write down, if the P ratio is higher than the standard or expectation, then it is overvalued. And therefore, you should not buy such mutual fund, because overvalued share prices will fall, means NAV will fall subsequently. Next factor is portfolio turnover. This fund manager buy and sell the stock. Check what is the turnover. Turnover means how many times he buys and sells. Is he buying and selling too frequently or not so frequently? The fund manager decides as to when he should enter or quit the market. A low turnover indicates he is neither entering nor quitting the market very frequently. So this person believes in buy and hold. A high ratio may suggest that too frequent moves have led to fund managers to miss out on the next big wave of investment. Some fund managers believe in this strategy: buy and hold for a long term. Some fund manager believes in this strategy: timing the market. Buy when the market is low, sell when the market is high. Now again, different people may have different approaches toward the fund management. Is it right? But this type of strategy, where they continuously churn out the portfolio, does not necessarily give a higher return than buy and hold policy if you look at the long term. If you look at the long term, over say 10 to 15 years, you will find a buy and a hold policy has probably given you more return than the one who is churning out the portfolio too often according to the market move. A simple average of the portfolio turnover ratio of the peer group updated by the mutual fund tracking agencies may serve as a benchmark. So now there are many mutual fund tracking agencies. They give you a lot of information about mutual funds. Check what is this fund's turnover, what is average, is it higher than the average or lower than the average, and accordingly you decide to invest or not. This ratio is lower of annual purchase plus annual sale to average value of the portfolio. So this way you can calculate the mutual fund turnover ratio. Take the annual purchase, lower of the annual purchase, and sale, divide by the average value of the portfolio. Open-ended or closed-ended? So which one should we buy? So that is what is the note, no? That depends on closed-ended also. One person is saying if we buy open-ended, if some big investors sell, NAV will fall. But that can also apply to closed-ended. There also the risk is that in trading in the stock exchange means that is also exposed to the risk only. Okay, so this much is enough. There can be some more points which you can write later. Now this question was asked in the SFM exam. Signals highlighting the exit of the investor from the mutual fund scheme, which they can ask in this exam also. Direct question, true false question, MCQ question, fill in the blanks. Is it right? That means you are already invested in a mutual fund, but you should look for signals. If you come across this signal, it is high time to say buy. Okay, and we should move to other schemes, other funds, other asset class. So first is when the mutual fund consistently underperforms the broad-based index. So nowadays what mutual funds do, they give you a comparison chart also. Suppose it is a index fund. Suppose it is a index fund. They invest in the 30 shares of BSE Sensex, for example. So they will give you their performance. They will give you what Sensex has performed over a period of time. And if you find that this mutual fund is consistently giving a return less than the Sensex, what this fund manager is doing? Is he managing your funds efficiently or inefficiently? Inefficiently. Otherwise, you could have yourself invested in these 30 shares. You would have got this much return. And here I am giving money to a fund manager who is actively involved, who gets salary to manage my funds, and is generating less return. Get out. Or I will get out actually of this mutual fund. Okay. It is high time that it should get out of the scheme. It would be better to invest in the index itself rather than by investing in the constituents of index or by buying into an index fund. So this is one example. Similarly, for each mutual fund, there are some benchmarks that they give. And you have to compare with those benchmarks over a period of time and see whether this mutual fund is giving you higher or less. Then mutual fund consistently underperforms its peer group. What is peer group? Similar schemes. So nowadays in the newspaper also they give you HDFC mutual fund, Birla mutual fund, Tata mutual fund, Reliance mutual fund. And here they will write the name of a scheme. Let us say equity fund. Simple name. 11%, 12%, 13%, 14%. When you are an investor of, for example, HDFC mutual fund, scheme is same. All of them invest in equity share. All of them invest in large cap fund. Okay. Large cap equity fund. Now you are wondering, others are giving higher return. My mutual fund is giving lower return. Time to say, buy, get out. Okay. In such a case, it would have to pay to get out of the scheme and then invest in the winning schemes. So this type of reports are easily available in the websites, newspaper. You can compare. And in case if you consistently find that this fund is underperforming, you can shift to other funds. Third is the mutual fund changes its objective. Normally not possible, normally, but sometimes yes. For example, instead of providing a regular income to the investor, the composition of the portfolio has changed to a growth fund, which is not in tune with the investor's risk preference. So an income fund becomes growth fund. Income fund, which was giving you regular dividend income, has now decided to become a growth fund. Growth fund does not pay dividend. Investor wants regular income. Investor wants regular income. So therefore, he would have to switch now, because this mutual fund does not meet his investment objective. Sometimes the investor's objective changes. This is where you have changed your objective. Okay. You were earlier a young person willing to take the risk. So you invested in small cap fund, equity small cap fund, where the investment is in small companies, risk is large, risk return is also high. But then now you have become old. Okay. You can't take the risk. You are on the verge of retirement. So will you still continue with that small cap fund? No. You can move to government bonds fund, corporate bond fund, debt fund, okay, balance fund. So it is time to exit from that small cap fund, move to the balance fund or debt fund. So human beings are like this only. Their objective will not remain the same. Now point number 5 is when the fund manager has been replaced by a new entrant. Already discussed. Your fund was managed by some reputed fund manager, but he has left the company. He is replaced by a young dynamic CA final pass student, group 1. Okay. Group 2 is appearing. but he's young, dynamic, 21 year of age. He got the job in place of that fund manager. What will you do? Continue with the fund or shift? He's a young, dynamic. Group 1 of CA final years passed. Huh? But no experience in fund management. Is it right? Person who can't pass group 2 of CA final, how you can trust him with your money? Yes or no? Because they have to write the qualification also of the fund manager in the prospectus or that offer document, that he is an MBA from Pune University, CA final group 1 passed, like this. So the moment you see such qualification, CA final group 1, no. Okay, you will shift to another fund or that fund where this old fund manager has joined. So these are some of the signals. Money market mutual fund. Oh, why did I say oh? It's already covered in the money market chapter in detail. So combine that and this. Combine that and this. Okay. But this is also a mutual fund. So they have covered here also. And it is a money market instrument. So it is a covered in mutual fund. Money market chapter also. So money market mutual fund, where do they invest? MMF, where do they invest? They invest usually in money market instrument, means short term instrument. Maturity period is less than 1 year. So the government of India thought of introducing money market mutual fund on Indian financial canvas in 1992. The aim of the government was to develop the money market and to enable individual investors to gain from money market instruments, since it is practically impossible for individuals to invest in instruments like CP, CD, TB, which require huge investment. Already I have covered this. If you remember, you are an article. I had given you that example. You have accumulated 50,000 rupees over 3 years of articleship, and now you want to invest in commercial paper of a company. Dreams are high. What is the minimum ticket size of a commercial paper? Minimum 25 lakh. 25 lakh, dear. Then in multiple of 5 lakh. And you have only 50,000. Still you want to invest in commercial paper. Between you and commercial paper, there is MMF. This is MMF. You invest in money market mutual fund. Like you, there will be 1 more, 2 more lakhs of investor here. They have got lot of money. They can invest in commercial paper. So indirectly you are able to participate in commercial paper, certificate of deposit, then treasury bills, etc. And these are very safe instruments. Very safe, because the maturity period is very low. Treasury bills are issued by government, so almost zero risk. Certificate of deposit is issued by reputed commercial banks, subject to RBI regulations, very low risk. Commercial papers are issued by reputed corporate houses, subject to RBI regulations, and that too for a very short period, so risk is less. Good for those people who want to park their surplus money for some months, some days, some weeks. They don't want to take a risk with that money, so they can invest in money market mutual fund. So the government constituted a task force on MMF under the chairmanship of Sri D. Basu. Now come to guideline in respect of MMF issued by RBI. Mark important, because in one exam they have asked a question from this paragraph. Which of the following is not applicable to MMF? Something like this, okay? and then the student has to really know where to search for the answer. The investment by individual and other bodies would be in the form of negotiable and transferable document instruments and MMMF deposit accounts. Okay, so this is the first thing. You have to invest by opening an money market mutual fund deposit account, and the investment will be negotiable and transferable. You can transfer it to other parties also. Minimum investment in MMMF will be 1 lakh rupees instead of that 25 lakh or something. You can also invest. You are a you are a high earning article clerk, high net worth article clerk. So 1 lakh is not big amount for you. The repurchase would be subject to a minimum lock-in period of 3 months. The fund will not be subject to reserve requirement. The fund will not be subject to reserve requirement. So they don't have to maintain any kind of reserve. CRR, SLR, whatever. Capital adequacy ratio. As this will be invested in money market instrument only. Minimum of 20% of funds will be invested in 182 days treasury bills. So all these details difficult to remember, at least for me, I will tell you frankly. But since it is an open book exam, keep this in mind. Minimum 20% of the fund should go in 182 day treasury bill, and maximum of 20% of the fund will be diverted to call money market. So it can't be more than 20% in call money market. So this is your guideline. Money market funds are generally the safest and most secure of mutual fund investment. Now these are not guidelines, these are just general information. Up to the previous point was the guideline. Some more guidelines are printed in that money market chapter also. Money market funds are safest because they invest in safe instrument only. The goal in money market instrument is not to earn a high return. The goal is to preserve the principal, and instead of keeping the funds idle, earn something. Instead of keeping the funds idle, you can earn some return. Whatever 5 or 6 or 8% return you earn, it's good than earning nothing in your current by keeping in current account. Money market mutual fund is like a high yield bank account, but is not entirely risk free. Why money market mutual fund is not entirely risk free? It is very risk free, but not 100% risk free, because they invest in, say, commercial paper of corporate. Sometimes the corporates may default in payment of commercial paper. Is it right? In one recent past, one company, investment, leasing and financial services, defaulted in payment of commercial paper. Mutual funds have suffered. Investors have suffered. If mutual fund incurs loss, you have to incur the loss. So when investing in money market fund, attention should be paid to the interest rate that is being offered. That is where they are investing, what return they are earning. Mutual funds do not give you interest. Mutual funds give you what is called dividend. If they are investing in abnormally high return investment, something is wrong also possible. Okay. So now quickly we'll discuss ETF. Oh, again ETF. It was covered in the first 2-3 pages also. You will find 50 to 80% paragraphs are repetitions. As the name suggests, ETFs are mutual fund but traded on the stock exchange. But it is not closed-ended fund, because closed-ended fund has an expiry date. The scheme is closed. All assets are liquidated. But ETF is like open-ended fund because there is no maturity date as such. It is like closed-ended fund because it is traded on the exchange. And they usually track some kind of index or some price index. Like they can track BSC Sensex, they can track NSE Nifty, or they can track Bank Nifty, gold prices, or any other precious metal prices, commodity. Okay, so exchange traded funds are a type of financial instrument whose unique advantage over mutual funds have caught the eyes of many investors. So now they are getting more and more popular as people have started understanding it. They started investing in it, because mutual fund itself was initially a complicated product, and now on top of that you are making it exchange traded mutual fund. So not everybody may understand the product first. So it is an hybrid product that combines the features of an index fund. I can put it like this: it is an index fund which is traded on the stock exchange. Is it right? A pure index fund will not be traded on the stock exchange. That is an open-ended fund. But a ETF which is tracking an index is giving you the advantage of an index fund also, and at the same time it is traded on the stock exchange, so you can buy and sell any time through your broker. These funds are listed on a stock exchange, and their prices are linked to the underlying index. Whichever index they are tracking, they will mention it to you that this is tracking Nifty, or this is tracking Sensex, or this is tracking gold price. The authorized participants act as market maker for ETFs. So all these people who are buying and selling in the stock exchange, they are the market maker. They are creating demand, they are creating the supply. Okay, so you are the market maker here. ETFs can be bought and sold like any other stock on an exchange. Each feature you have to remember, or if not remember, at least understand, because you have to search for these lines in the exam. And I will take 2 case study on this chapter. You will realize from which corner they can ask the question. Okay. In other words, ETFs can be bought or sold any time during the market hours at prices which are expected to be closer to NAV at the end of the day. Underline, because in one case study, this is a MCQ question, that the price of ETF is, so the answer was closer to the NAV at the end of the day. Therefore, one can invest at real time prices as against the end of the day prices, as in the case of open-ended scheme. Now, what is the difference between open-ended and exchange traded fund? In open-ended scheme, once the day closes, normally the mutual fund will declare the NAV, that this is the NAV at the end of this day. Now, if you purchase the mutual fund in the next day morning, then that NAV will become applicable. Okay. But in case of ETF, it is on real time basis. If you buy at 11 o'clock, whatever may be the price, that will be applicable. If you buy at 12 o'clock, whatever may be the price. As the value of that underlying securities are changing, the value of your ETF mutual fund will also keep changing, and therefore it changes on a real time basis. There is no paperwork involved for investing in an ETF. You have to open a demat account, and just like you buy share, you buy this ETF, it will be kept in your demat account. You can sell it, buy it. You can just buy and sell it like any other stock by placing an order with a broker. An exchange traded funds trades like a stock. How many times they have written? 4 or 5 times they have written. Have you observed? Just like an index fund, because they have copied, pasted from different materials. Okay, and therefore there is a repetition. They did not even bother to edit. You also. Okay, I thought you were blaming me also. I am reading the whole material, study material plus something more. I am not deleting, I am only adding if required. Because if they ask question from some corner of the book, you should have that material with you. Okay. Just like an index fund, an exchange traded fund represents a basket of stock that reflects an index such as Nifty, BSE, S&P, Standard and poor 500. This is a, I think, US stock exchange index, S&P index 500, quite popular in USA. Then an exchange traded fund, however, is not a mutual fund. It trades just like any other company on a stock exchange. So it's a hybrid product. It is a mutual fund, but it is also traded on a exchange. Unlike a mutual fund that has a NAV calculated at the end of each trading day, an exchange traded fund's prices change throughout the day, again repetition, fluctuating with the supply and demand. It is important to remember that exchange traded funds attempt to replicate the return on indices. There is no guarantee that they will do so. You can only copy. You can't become. Okay. You can only copy Sachin Tendulkar. You can't become Sachin Tendulkar. So it is same thing with ETF. They are trying to give you return which is close to the index, but sometimes they fail. They give lower return. Sometimes they give more also. It also depends on the expense ratio, etc. It also depends when you have bought or you have sold, etc. So it is not uncommon to see a 1% or more difference between actual index year-end return and that of an exchange traded funds. By owning an exchange traded fund, investor get the diversification of an index fund plus the flexibility of a stock. So this is it is treated as, just for information, one of the best innovations in the field of finance, that is exchange traded fund. Okay, that is in USA they have created this product, and then slowly and slowly it became very popular across the globe. Because exchange traded funds are like stock, one can short sell them also. So you can short sell, later on you can purchase. You can do margin trading also. With a small amount of money in your pocket, an amount borrowed, you can purchase a large amount. That is called margin trading. We have discussed in one earlier chapter. You have 20,000, your broker will finance you 50,000. You can take a position of 70,000 rupees. So because it is traded on the stock exchange, margin trading is also possible. Short selling is also possible. And another advantage of this exchange traded fund underline is the expense ratio is lower. Expense ratio is lower. Why? Because you don't have to actively manage it. You don't have to actively manage. Why? You have decided to invest in 30 shares of Sensex. At least the list of shares are clear. You have to decide the amount. So you invest in proportion. Even that amount to be invested is roughly clear. Now only from time to time you have to just buy and sell some stock. So relatively the fund manager effort is lower compared to other open-ended scheme or closed-ended scheme. When buying and selling exchange traded funds, investor pay their broker their commission, same commission which they would pay on the regular trade. So this is the drawback, you have to pay brokerage. A greater reason to consider exchange traded fund is that they simplify the index and sector investing in a way that is easier to understand. So instead of you putting your money in so many sectors, so many shares of a sector, so many shares of an index, just buy ETF. Okay. If they feel that turnaround is corner, extra gyan. If you think that now the prices are going to go up for this index, if this index is going to rise, people are saying Nifty will rise, buy the ETF. If people are thinking that no, Nifty will fall, sell the ETF, Nifty ETF. The combination of an instant diversification. You get instant diversification. You buy ETF, you are buying 30 shares of Sensex or 50 shares of Nifty. Low cost, very small amount. You can buy one ETF also. And the flexibility that exchange traded funds offer means you can buy and sell anytime. makes this instrument one of the most useful innovations and attractive pieces of financial engineering to date. Okay. Next is, when did ETF started? First time it came in USA, 1993. And then it took several years for their public interest. But once did, the volume took off with a vengeance. So now the volume is very high. You can see the statistics over the years, more than $120 billion, and that too the statistics is of June 2002, is invested in about 230 ETFs of trading volumes on American stock exchanges are from ETFs. 120 billion is also a big number. Yes or no? Now, the most popular exchange traded fund, they have given some name, QQQ, triple Q. They are called cubes based on Nasdaq 100 index. SPDR, while pronouncing, they pronounce it as spiders. This is Standard and Poor Depository Receipt. SPDR full form is Standard and Poor Depository Receipt, based on the S&P 500 index. There it is written based on the index. You make it S&P 500 index. This you have to write. S&P 500 index. This is another ETF. And suppose they ask, what are the following instruments? QQR, SPDR, iShare, TR, HAK, AHK. So you have to say these are ETFs. Okay. The option can be ETF, share, potato, copper. So then you have to see these are a variety of ETFs. iShares based on MSCI indices, and TRAHK, which is pronounced as tracks, based on, in your book you make a small correction. If it is written hand, you make it Hang Seng. The indices of Hong Kong Stock Exchange, is it right? And they have written the average daily trading volume in cubes is around 89 million shares. The following ETFs are being presently traded in NSE. So quickly, list of some ETF traded in NSE: S&P, CNX, Nifty, UTI, Notional Depository Receipt Scheme. In short, it is called Sundar. If you do the abbreviation, Sundar. So nowadays, first you find short form, then you find full form. Liquid Benchmark Exchange Traded Scheme, Liquid BEES. So this BEES means Benchmark Exchange Traded Scheme. Junior Nifty BEES, Nifty BEES, Bank BEES. Okay. ETFs can be bought or sold through trading terminal anywhere across the country. Bas karo bhai. How many times you will write? A comparative view of ETF with other funds have been given in the following table. Now we will take a break. Then we will see this table where they have given a comparison chart of open-ended fund, closed-ended fund and exchange traded fund. Okay, after the break.